But there's more to the story. Because now you've done dividend tax, the next one is the increase in capital gains tax. And this one has far more of a potential to hurt you if you are invested through the wrong vehicle. So what they do is they say, we increase the inclusion rate for capital gains tax on companies to 66.7%, and for individuals to 33.3%. But that's not the tax rate. You then have to apply the tax rate to the included income, which means that corporate CGT rate goes up to a flat rate of 18.67%. And then individual goes up to 13.33. So what do we see? A higher CGT rate in companies than in the individual's own name. And also remember that that 13.33 on the individual is the maximum if the individual's other income is over 617,000 Rand a year. Otherwise, that rate will be lower. But it goes further. Because now, if a company has made a capital profit and wants to distribute it, it now distributes the 81 and it incurs dividend tax again. So you get CGT and dividend tax on the same profit, and that takes up the capital profit in a company, once it's distributed, to 32%, when last year it was 22.6. It's gone up 10%, compared to the individual rate of 13.33% maximum on a capital gain. Now, you know that chap who comes in along, he says, I've got CCs. I've got a CC for everything, right? Or I've got an investment holding company and me and my spouse are directors. You're saying, well, why are you doing that? Do you want to pay more tax? If you want to pay more tax, please make a donation, okay? You've exposed yourself to a whole lot more tax on your capital profits than is necessary. Why are you using an investment holding company? But then it goes even further. We say, right, go to trusts. And there they say, right, increase the capital gains tax rate to 66.6. Apply the 40% tax rate flat for trusts, and you get a flat rate of tax of 26.7 for trusts, compared to 13.33 in your own name. Again, you go into the family business, and the guy said, I've got trusts. Me and my wife are trustees. Very much so. And you say, well, do you want to pay double tax? He says, I'm going to get off estate duty. I say, is there something wrong with you? Are you going to die? He says, no, man, I've got a clever accountant. What he can do is cause the income to vest in the beneficiary. And that will bring the tax rate back down to 13.33. And you say, okay, that's fine. But then you're defeating the object because you've pushed everything out of the trust, you've lost control of the income, and your kids can spend it. Be very careful when you go the route of vesting because you've lost control of your money. So what we're saying is, in the use of trusts, we have to be very, very careful, and there is a very, very limited, specific reason for having trusts. You don't form a trust simply to look good in the pub. There is definitely a case in South Africa that far too many people have got trusts. People say, well, what about estate duty? And I say to them, well, you're not dead yet. Is there something wrong with you? And they say, no, I'm healthy. So I say, well, then your life expectancy is 80. And by the time you get to 80, well, I don't think we'll have estate duty anymore, but presuming that we do, your kids will have probably walked off with half of it and the medical profession with the other half. So, there's going to be no problem anyway. That's the sort of problem that you get with it. So please, the slide on tax rates and where we are going is absolutely situation critical. On top of all of that, there is an annual 30,000 Rand exemption on capital gains of the individual taxpayer, and you don't get that in trusts and companies. That's also a major change. What does it mean? It means that arbitraging between capital and revenue is very, very out of sync now. We don't need to go for it. Remember, we used to have full tax on revenue income, zero tax on capital income. And over 10 years, that's gone up to that the difference between the two is only 5.39%. Now, emphasize what the difference is. Last year, the highlight of the year for the tax profession was CSARS versus Founders Hill. It was a SCA decision about capital and revenue profits. And what the taxpayer did was they had a capital gain, they defended themselves in the Johannesburg Income Tax Special Court successfully, and SARS appealed it to Bloemfontein. The taxpayer said, "Why are you appealing? I've already won." They went off to Bloemfontein, taxpayer lekker confident, and they came back, as we say in the classics, opgefok met kostes. SARS took them out completely, right? And the reason nowadays we're saying, why expose yourself to that risk? It's not worth fighting over for 5%. You're not even going to pay the legal fees. Do you see that the emphasis in tax of capital versus revenue is a completely different thing? I'll explain that a bit more later. Preference shares are on their way out because the STC credit is phased out after 3 years post-dividend tax implementation. And most of the preference shares that you see on the market today are in one way or another based on the utilization of an STC credit. Once that's gone, preference shares go. So you've got to say, hey, that's a fundamental change. Because grannies love preference shares, don't they? They say, we're not paying tax. Well, yes, they're getting tax-free income, but they're not looking at the underlying tax and costs on preference shares. And, well, that one's going out the window, so grannies will have to go back to, hopefully, the new savings scheme that they're going to bring in 2014 to replace it with tax-free interest. The arbitrage between corporate and individual on revenue income is now 2.6%. It's not worth forming a company. The arbitrage between the individual and a corporate on capital income, which is where you're hoping to make all your growth, is 19%. Who wants a family investment holding company and go and expose yourself to that? And then they're even bigger because when we get to pension funds, they've now been made totally tax-free. And so we get an arbitrage of 37% on revenue income and 32% on capital income. And then we get an arbitrage between trusts and individuals of 13.33. What we see in this is that it is absolutely critical that you recognize and get the right vehicle for your investments. And that is normally individual taxpayer in his own name or using a retirement fund. I'll show you more in a moment. And 4. Investment companies and trusts used to be the rage. No longer necessarily the case. There are specific applications of them, but they're very expensive. And for many South Africans, they don't need them. Today, it's about creating a plan around your wealth in your own name and that of your spouse and the use of retirement funds. More about that in a moment. If we take the JSE, since Zuma came in, he will say, well, the market was looking pretty shoddy when I got there, and it's looking lekker today. Well, that's just political talk. Where did it really go? If you take 100 Rand on the day that JZ came in and you increase it with CPI in the red line, you are at about 115 to 120 today. Post-tax interest is below that level. You've gone backwards if you have been investing taxable, and if you were investing in interest-bearing tax-free, you may be just a little bit above it. If one goes to equity growth, you can see that we're up at 160. Not only has the market done okay, but also there's been a lower tax rate on the income because it's been a capital gain. So we say, gee, there's a huge difference not only from return, but also from income profile. That's important. So lesson 5. Post-tax interest rates are below inflation. CGT has been increased. Does make a huge difference on the individual. Dividends tax is now in, and that comes in at 15% regardless of what type of taxpayer you are. That's a 15% non-refundable withholding tax on the individual. You pay it, and that's the end of it. You can never get it back. But you can solve all of those problems by simply holding your investments in a retirement fund. But let's show you how that works. Now, this is the website reference. This is the one thing you can write down from this morning, www.criticalthought.co.za, because the video of this will be on the website. And this particular app is there on the website for you to show your clients and download and use the calculations. So there's a little video, and there is also the calculator is also there. Goes like this. When one looks at retirement plans, they give you these lovely pictures in the promotions of happy, young, grey people running around without a care in their life on the beach. Looks something like a Viagra advertisement, doesn't it? Now what we are saying to people is no, we should be promoting these things as follows. We say go out in your own name and build up an investment portfolio. What are you doing? You are buying your investments in after-tax money. You're exposing yourself to tax on interest at up to 40%. You will pay dividends tax at a flat rate of 15%. When you dispose of your investments, you'll pay CGT at up to 13.33%. And then when you die, you will have a capital gains tax event because that will be a deemed disposal, and it will be included in your estate duty computation. However, change it just a little bit and buy your unit trust through a retirement annuity fund, and there's a tax deduction of up to 40%. They are looking at capping contributions, but look at the levels. 200,000-300,000 rands a year. How many clients do we have that actually get to that level on a contribution? One a year? Then, interest income in a retirement fund is exempt. Remember, we had retirement funds tax. That was a recommendation of Michael Katz many years ago. It didn't work. They took it out. There is now, from the 1st of April, a complete exemption from dividend tax if the dividend is paid to a retirement fund. And then there's also a complete CGT exemption within a retirement fund. Want some more? On death, we get a CGT exemption and an estate duty exemption. All 5 taxes better off using a retirement fund. So people look at that and they say, well, so what? I'll tell you, Matthew, watch out the sting in the tails when you come out of the retirement fund. So I say, yeah, that creates taxable income, but on withdrawal, let's have a look. And we say, yes, when you are contributing, hopefully you're earning over 617,000, so then you are going to get a 40% rebate on your investment, or tax deduction on your investment. When you retire and you draw the income out, then we're sitting in an old age home without a salary. So you're fitting up the bottom end of your tax profile. So you're not going to pay 40% when it goes back. You're probably going to pay a hell of a lot lower. If you're over 65, you can receive 99,000 rands a year of retirement annuity payout, completely tax-free. Over 75, 110,000. And only then will you start paying tax. So even if you just use RAs to please fill up the first 100,000 in your retirement, and that will grow every year, well, then you're on the right track. So what you're complaining about? Oh, they continue to complain. So I said, well, here's some more. You can also take a tax-free lump sum on retirement. First 315,000, and this has been unchanged now since last year. The first 315,000 of your lump sum from your RA tax-free. Number 2, up to 630,000, it's taxed at a very respectable rate. Your average rate of tax on a lump sum on 630,000 is 9%. That's not too shabby. And it never, ever gets back to 40%. So the argument that you're just going to pay it back, you're saying, give me a tax deduction now. Give me a tax exemption for 15 years. And then we'll talk about the tax coming back. And that's the magic in a retirement fund. But the problem is people don't understand that. They don't see how you structure it in. Want some more? Well, what about your medical situation? Currently, if you use a retirement annuity income to pay your medical aid premiums and your medical expenses and you're over 65, retirement annuity income coming out equals medical expenses equals no tax. That will change in 2014, but only if your income is over 250,000 rands a year will it start to hurt. And even then, the maximum that you can be hurt is 15%. So you're borrowing with a 40% discount, investing with a total tax-free state, and paying a maximum tax coming out of 15%. Where can you get that? I think it should be, I personally think it should be subject to donations tax. It's so good. It's fantastic. But your clients don't understand that. They're not financial people. So this is where we give them a calculator. This calculator you can get from my website. It's a simple demonstration to a client of the benefits of using a retirement annuity fund. I want to retire when I'm 65. I'm currently 50. I've got $10,000 a month to invest, 75% to equities. My savings will increase with inflation. My interest rate and the inflation rate are the same. That's where we are at the moment, but you can adjust it in the model. My equity growth rate is 3% above the inflation rate. Very conservative. My dividend yield is 3% below the inflation rate, currently about 3%. Inflation rate 6%. My marginal tax rate at the moment is 40%. By the time I get to age 65, my unit trusts should be worth 1.8 million. But if I'd reinvested the tax saving and bought the same amount through a retirement annuity fund, I'd be worth 3.1 million. Extra 50%. There you go. And what I'm saying is you cannot build a retirement fund and discard that. You've got to get the tax profile right. So you can download all of that off my website, use it for free, send it to your customers, whatever you want. Have a look. Lesson 6. Tax is critical in investment growth. Absolutely important that the client understands it. But the only way to get them to understand it is to give them the calculations. That's absolutely fundamental, critical, to show them what the two alternatives do to each other. Now you move to transaction taxes, and you say, what's that got to do with retirement planning? It has a huge amount to do with retirement planning. Firstly, VAT. VAT stayed at 14%, and it will stay at 14% until we decide what we're going to do with NHI. But now what we've got to say with that is, what's the big issue about VAT? And the thing is, it's the second biggest tax of all. People want to say, Matthew, give me a way to save tax. They always say, off income tax. I say to them, why don't you just stop going to the mall and drop your other tax, okay, your VAT? That's important. Now, what we've seen over the last year is that the consumer is sulking. Why is the consumer sulking? Well, the VAT collections got really stunted by the global credit crunch. Over the global credit crunch, life turned into a bring and bri. And that's recovered a little bit, but it's still a little bit tentative. They say the problem with the consumer is that the demand will remain weak because the consumer can't borrow. And they're at 75% of household debt is currently at 75% of GDP, and 14% of salaries is spent on repaying debt. Right. What's the unofficial explanation? We've got the National Credit Act, you can't borrow anymore. You've got increased fuel prices, 30% in a year, electricity 30% in a year, and it's going to do it again for another year. Then the cost of educating your kids and paying the rates and taxes on your house has gone through the roof. What's wrong? We're all so broke we can't pay attention. And the thought of going to the mall with your credit card is just terrifying. So if you go to the mall, you leave your credit card at home and you go window shopping. That's what's really happening, and that's where they're struggling with that.